Good morning from London. I'm Manus Cranny alongside Danny Berger in New York. You're welcome to Bloomberg Brief. Let's set that agenda.
Another day, another record for Wall Street as Fed Chair Powell emphasizes two-sided risk. Day 2 of his testimony starts today. The Veep stakes heat up. Trump teases his running mate. Meanwhile, Biden gears up for the NATO summit as rifts emerge in his party. Turning down OpenAI. Microsoft and Apple give up their observer seat on the company's board as antitrust scrutiny grows. Manus, good morning to you. You've left me for London this morning. It's mighty lonely and quiet on the set without you.
I've abandoned you for a slightly less hot temperature city, but you come home and suddenly you find out subways around the world, they've all got the same issues. One issue that we've got to put some context around this morning is this breathless run, 36 records in the S&P 500. If we trade in the green today and up and onwards, it could be 37. Has Powell really got a trigger-happy finger for September? BMO, we're talking about the possibility even of July in terms of the rhetoric. We'll talk more about that in just a moment. BlackRock say you want to broaden your AI trade. TSMC, of course, trading through $1 trillion, and their sales being the fastest since 2022, has had a lovely reverberation around the rest of the market. To NVIDIA, a normal market check for you. No real movement on Microsoft or Apple as a result of them stepping back from the board seats. There are the bonds. 428 is where we are. Look, $36 billion worth of tens went fine. That went grand. Powell wants more good data. And as we say, there is term premium now in the bond market. Is this your opportunity to pick up if they do pull the trigger for September? I thought we'd just genuflect to iron ore, Danny, down 3.7%. Can we break the $100 level? We have that disinflation narrative in China and the overhang in the property market. It is still very, very live and very prescient. Danny.
Manus, let's get into the Powell rhetoric. What stood out to me was a ever so slightly more dovish Powell saying that elevated inflation is not the only risk we face. The most recent labor market data do send a pretty clear signal that labor market conditions have cooled considerably. Yes, that's kind of dovish, but here's the problem for this market, Manus. We're already pricing into cuts. That's already one more than the dot plot suggests. So for a bond market rally, does it really have legs when a slightly more dovish Powell is perhaps only in line with what the market is already priced in?
Well, he wants more good data. I just wonder to what extent the CPI later this week can perhaps invigorate that. And we've had this sort of breathless run, not just in the Mag 7, but also in those steepeners. And the question is, of course, will Biden stay? What will happen if there's a GOP sweep? And what happens to that Fed in that case, Danny?
And Powell avoided basically every chance to comment on it. Maybe the most clear he got was a question about immigration. And he said when it comes to inflation, it's neutral. In labor market, it's short-term positive. He did, though, emphasize the independence of the Fed. He made it very clear in his opening statement, something he usually doesn't do, potentially trying to get ahead of the election, Manus.
Well, certainly, if you listen to Adam Posen, there's a whole other world for the Fed to consider in the back end of 2025. Let's just reflect. We're counting down to the CPI number. The Chair Powell told lawmakers that he wants more evidence of that cooling inflation.
The most recent inflation readings, however, have shown some modest further progress. And more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation.
Joining us now in our London studios, Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Good to see you in person. In the flesh, back in London. Look, if you reflect on Powell yesterday, trying to thread this needle ever so delicately, inflation, the disinflation story is in train, but what is it that hangs over the Fed? So is it a 1980s risk of a new politics, the Reagan politics of the 1980s, and having to do a hard pivot? What is the shadow that hangs over the delay in the Fed?
Well, I think it's partly because inflation hasn't come down as quickly as they were hoping earlier in the year. And, we shouldn't forget that markets have had to adjust their expectations quite radically about the number of rate cuts because service sector inflation has been quite sticky. And they don't want to cut rates too early before they get that decisive degree of confidence that inflation is really under control. We think it will be, but I think it's also important to mention that the markets have taken sort of bad news on growth as being positive because it's helping to boost the confidence that rate cuts are coming. But we have seen a slowing in the data, and as Danny says, particularly in the labour market.
Yeah.
And, there are two-side risks here, certainly, in terms of equities, certainly.
And Peter, I know we spoke to you, Manus and I, just before the jobs data of last week. And after the jobs data, there's been a lot of conversation about a certain fairy tale character that likes to eat bear's porridge. And to your point, this equity market has taken that kind of bad news as good news. What needs to shift for the bad news to be bad news, for there to be not just softening, but something that's really soft and worrisome for corporate growth?
Yeah, look, I think absolutely. Firstly, context is important here. Since the period where investors have really started to price in a soft landing with rate cuts, last October, global equities have gone up more than 30%. The Nasdaq's gone up more than 45%, with an extremely attractive, sharp ratio. So a lot of good news has been priced in. What we are starting to see is a loss of growth momentum. Not recession, but if we look at our own macro surprises index, for example, it's turned negative in the US and in other places too. So that loss of momentum has supported the idea that rates cuts are coming. But as you say, you don't want growth to be too low either when confidence is so high about earnings coming into the second quarter. So I think the real catalyst for maybe some kind of softness in the equity market is any disappointment in the second quarter. Remember, expectations are running pretty high, and particularly so for the dominant stocks that are so important in driving the index.
Look, the language that I think the three of us used, coalesced around when you were with Danny and I last week, was you said, look, we're at a tricky point. Everybody says, look, exceptionalism can continue in the dollar and in equities. You would say we are not irrationally exuberant. Would you welcome a 5%, 10% drawdown to sort of relock and reload? Would that be a bit of a gift if there is a genuine pause in these markets?
Yeah, look, bull markets don't go in a straight line forever. We've had quite a long period without a setback of even 5%.
Yeah.
Now, that in itself doesn't tell you anything. If the fundamentals continue to be good, and there is a lot of money sitting in cash on the sidelines, the market can make progress. But we need to emphasise that although there's not been an irrational move in markets, the rise has reflected confidence in a soft landing, ongoing profit growth, particularly in the dominant tech stocks. Valuations have gone up a lot this year. In the US, the market is trading well above its 20-year previous peak, even though growth is weaker and interest rates are higher than they've been at points over that period of time. We've got a very, very concentrated market. We're seeing recently that any stocks that do disappoint are being heavily punished. Yeah. And so I think as we go into the second quarter with heightened expectations and a softening in the growth momentum data and these high valuations, some kind of setback, I think, probably would be quite healthy. And it's important to emphasise, I think, the risk of a bear market is quite low. Generally, if economies are growing, profits are growing and rates are coming down, it's unlikely you're going to see a major resetting downwards in equities. But a correction after the rise that we've seen, I think, is much more likely. And I think investors need to be looking at diversifying the risks a little bit as we move into the summer.
Peter, as we think of diversifying risk at this moment, I mean, even just beyond the concentration of this equity market, it is a weird market, which is maybe understating it. When you have correlations that are rock bottom for the 21st century, even within asset classes themselves, correlation has essentially evaporated. What do you do with that, with an anomalous market that isn't really trading historically how it usually does?
Well, of course, that fall in correlation within, for example, equities, stock-by-stock correlation, is partly a reflection of how the super large dominant companies have moved ahead of the rest of the market. So stock by stock, you're not seeing the same degree of concentration as you have seen, of correlation as you have seen in the past. And that's true not just in the US, but other markets like Europe as well, where the dominant group of companies that we call the granolas, have also become increasingly large in relation to the index and having a disproportionate effect. I think what it does tell us is that the opportunity to look for alpha relative to beta now is going up. That means more differentiation and indeed more diversification. People should be less focused, I think, on the location of the company, but more about the fundamentals. You know, we look at ways of diversifying by looking at what we call ex-tech compounders, global companies that have some of the characteristics of large cap tech, you know, high margin, strong balance sheet, high recurring cash flows, but are slightly cheaper. And we would also balance that a little bit with some deep value. You know, it's a very interesting market. It's been a very long time, for example, where you could say that large cap US tech has performed very strongly alongside things like European banks. You know, the archetypal deep value part of the market, a serial underperformer for a decade, but actually a favoured sector from our perspective and doing very well this year.
I know that you've done some work around volatility between the US and between Europe. I mean, Europe is lit up with unexpected politics. How to avoid a phone call from Goldman's communication department? I'm going to ask you a question about politics. But we're debating whether Biden remains on the ticket, whether there's a mounting possibility of a Republican sweep. Everybody's talking about it. Everybody's talking about how you prepare for that, in the bond market. Right. I said to you last week, the bond markets are perhaps a little bit further along than the equity market. But how much time are you now spending reflecting on perhaps shifting, hedging, considering a Republican president? If Biden does step down, that's a nuance. But is there a shift in the narrative on positioning?
I think there is a little bit. Look, we should say that this was always going to be the year of elections. Everybody knew that coming into it. But we've had a series of quite surprising outcomes in a lot of high-profile elections. Mexico, Brazil, India, the timing of the UK election. Not a surprising outcome, but certainly the timing of it. And, of course, what we've seen in France as well. And so I think people are really beginning to focus on what the implications of these greater uncertainties may mean. Now, one implication is related to rising government debt levels and what that means under either outcome in the US, but indeed across Europe as well. We're seeing developed economies experiencing record amounts of government debt relative to GDP, and more demands are coming, more spending on defence, on subsidies and tax breaks to support energy transition. And that's what's, I think, keeping the long end of the yield curve more sticky and indeed making the equity market looking relatively more expensive compared to bonds. So I think the focus on politics here from an economic perspective increasingly is going to focus on the costs in relation to higher deficits.
Peter, really great to hear from you this morning. Come join us after the second quarter earnings so we can debate whether or not they lived up to those high expectations. Peter Oppenheimer of Goldman Sachs. Manis, let's get to some of the other top stories that are trending on the terminal this morning. Starting with Barclays, the bank is planning to triple staff across key Asia wealth markets. They'll undergo a major hiring spree over the next few years, focusing on the ultra-rich and family offices in India and Singapore.
Vladimir Putin is on a diplomatic role at home and abroad. The Russian leader has held more than 20 meetings with leaders from Europe, Asia, Africa, Latin America, and the Middle East. Putin's diplomacy is defying efforts by the US and its allies in the West to cast him as an international pariah.
China's consumer prices eked out another small gain in June. Monthly CPI growth hovered near zero for a fifth month. Deflationary pressures continue, yet it is the PBOC wary of lowering rates for fear of a weaker yuan. Manis.
Coming up, Trump teases his VP pick at the rally in Miami yesterday, stopping short of making an announcement, Danny.
And Microsoft and Apple give up the chance to be observers on OpenAI's board. We're going to look at what happens next for the AI company and the regulatory scrutiny that might be behind that. You're watching Bloomberg Brief. It's your Bloomberg Brief. I'm Danny Berger. In New York, Manis Cranny is on the road in London this week. Now, Donald Trump injected the kind of reality TV drama he's perhaps remembered for in his campaign rally in Miami yesterday. The former president repeatedly teased Florida Senator Marco Rubio as a running mate. He also mentioned Senators J.D. Vance and Tim Scott were on his short list. Joining us to discuss is Anne Marie Hordern, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance. I mean, I don't really know what to say about this, Anne-Marie, because it does have this reality TV show feel to it. I mean, are any of these ones that he's teasing serious contenders for the VP pick at this moment?
They're serious contenders. He said that, but he has yet to announce. And he's making this more of a show, which it's Donald Trump's world, and these potential contenders are just playing in it and vying in it. They might not even know yet. I'm sure a lot of them have been vetted, but they might not even know yet that they've been chosen. What we do know is that Trump was on Sean Hannity's show 2 evenings ago, and what he talked about was the fact that he is under a little bit of pressure to pick it before the convention. The convention is next week. He said he would love to announce at the convention because he thinks that would be a lot of drama and excitement, but his team, I think, is trying to get him to make this announcement earlier. But he is trying to build momentum around this, especially as the media's attention has been firmly in the Biden camp. Trump made it very clear to Sean Hannity, and a number of times he said this individual needs to be able to govern, would need to be able to step in as president, and also needs to help get him elected. And one thing is interesting, Trump did insinuate that it maybe would change who he chooses depending on who is actually the top of the ticket for the Democratic Party. If it's not Biden, does Trump have to pivot? And he kind of insinuated that to Sean Hannity, but didn't come out and say it. And yesterday in his rally, he didn't just go after Joe Biden. He started calling it the Biden-Harris ticket. The campaign is now thinking potentially, if it's going to be Kamala Harris, they need to make sure they're also attacking her and not just going after Biden.
Well, look, these strategies pivot day by day, and we need to understand where the Democrats are. But if we just finish off with who's on this VP ticket, it depends who he wants to appeal to. Because when he had Mike Pence, he was appealing to the evangelicals back in 2016. Here we are, what was it? Little Marco is what he referred to Marco Rubio back in 2016. It's which area is he appealing to? Is it the crypto world with Vance? Is it, a different group with Rubio? What do you think the priority is for him? I mean, it's a hard one to define. But as you look at that lineup, who do you reckon is top of that Trump?
I think one thing that the Trump campaign sees is that it cannot be someone that annihilates the base, the Trump hardcore supporters, but also I imagine the campaign would want someone that can also expand the president's appeal to independents, especially in swing states where this is where the election's going to be won or lost. So then if you think of someone that potentially is maybe more appealing to what Terry Haynes would call a unity ticket, he always talks about Nikki Haley. Yesterday there was a story that she is releasing her delegates to the former president. She said she's not going to the convention though, but someone like her or someone like Governor Glenn Youngkin, who the Wall Street Journal editorial board likes to talk about a lot, those individuals could be seen as maybe more of a unity ticket. If you want to get someone that's more hardcore for the base, then maybe they go for a Senator J.D. Vance.
And meanwhile, in the Democratic Party, Trump and team are probably enjoying the division between them. A seventh congressperson has come out saying that Biden should be replaced on the top of the ticket. How strong is that momentum? Because it does feel like it's a defiant Biden and a divided Democratic Party that maybe doesn't make that momentum as strong as it first was after the debate.
There is a schism within the Democratic Party, and these are just individuals, and the latest being Representative Sherrill. These are just individuals who are coming out publicly and saying this. Behind closed doors, the voices are a lot louder. And we did see Republicans, Democratic senators and congressmen and women yesterday meet behind closed doors, and the reporting out of that is that the numbers were actually in the double digits who are saying we're nervous he should step aside. But Biden has been defiant about it. Really, the test is going to be tomorrow. He is giving a press conference. How does he perform? Because every movement, every word is going to be scrutinized.
Okay, Anne-Marie, thank you very much. Every move, every twist, every turn. Let's see where they are. Anne-Marie Hordern will be on Bloomberg Surveillance in just under 45 minutes. And, of course, today's guest is going to be the Democratic Representative Jonathan Jackson of Illinois. Catch that interview, 7:15 a.m. Eastern. Breaking news, we're in London. It's no coincidence. HSBC, they are shaking up the investment bank to look like their rivals. Don't forget the huge downscaling at UBS, reduction in risk-weighted assets has been the focus. HSBC said to merge and certain teams on the global investment banking side. We've seen them change their infrastructure in the United States of America. They're going to reshape. They're preparing to merge. They're going to change some of the top leadership and appoint a new CEO very shortly. Servicing clients is our top priority. So breaking news from HSBC. We'll break that down in a little bit more detail right here on Bloomberg. Time for your front pages now around the world. First up, we've got the New York Times tracking the race for the White House. What else? Top Democrats swallow fears and back Biden. Top Democrats at Congress aren't willing to launch efforts to push Biden aside. Not yet, Danny.
And meanwhile, in the Washington Post, they're writing that Moscow, Modi, and Putin embrace close ties. Modi described Putin as a dear friend. They apparently gave each other a bear hug. This is the Indian leader's first visit to Russia since the Ukraine invasion in 2022.
And Danny, New York City has a penthouse up for sale, $135 million. Now, the question is this going to be one of the priciest deals? Will it close since 2022? $10,000 a square foot, Danny. Heck of a penthouse.
This is the thing, Manus. This space is unfinished. They literally have to finish building it out for $135 million. I mean, you'd hope the whole thing would be done. I don't know. I don't know how good of a deal this is.
Yep, you're right. Nick Candy's is up for sale here in the UK, $175 million.
Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Manus Cranny on the road in London. Let's set your agenda.
Another day, another record for Wall Street as the Fed Chair Powell emphasizes two-sided risks. Day 2 of testimony kicks in. The Veep stakes heat up. Trump teases his running mate. Biden gears up for the NATO summit as rifts emerge in his party. And turning down OpenAI, Microsoft and Apple give up their observer seat on the company's board as antitrust scrutiny grows. Danny, good morning. Can we make another record on equities?
36 records this year. It's hardly a lot of confidence behind it when we get to that record by less than 0.1% of a gain. The same sort of thing is happening this morning. We're up on the S&P 500 future session, up just by 0.1%. Your U.S. 10-year yield down by a basis point, 4.28% is where we stand. During Powell's testimony yesterday, you did see yields creep higher because maybe we were disappointed he wasn't as dovish as we expected. This is the thing with Powell. The risks are asymmetric because we expect a dovish Powell. Even so, you end the day with yields lower thanks to an auction that goes, by all accounts, pretty well. So that trend continues. Brent crude whipped around this morning. It started out weaker off the back of weaker China data, maybe showing that demand still isn't robust. The PBOC doesn't want to lower rates because what it means for a weaker Chinese currency. But that turns around over in the past 30 minutes. Brent crude at this moment, Manus, at $84.89 a barrel.
Look, Danny, there's no doubt about it. It's day 2 of testimony from Powell, and that's going to be the key focus for markets. I mean, he focused in on the jobs market, strong but not overheated. The labour market conditions, they've cooled considerably. So there are nuances here really pushing the dual mandate, Danny, rather than necessarily focusing on that inflation. We've covered this a number of times. I was surprised when I read BMO's note that they felt it was a modestly dovish skew and even raised the possibility, Danny, of a July cut, which I think is maybe on the right tail risk.
It's definitely on the tail risk. But we are already pricing into cuts, Manus. This is what I come back to. If you have a slightly more dovish Powell, what do you do with that? I mean, again, this market has already moved more than the FOMC has in their dot plots. What I want to hear from next, Manus, are the other FOMC speakers. Because if Powell wants to cut in September, he probably needs the rest of the board with him for fear of it looking political if he goes out on his own.
And look, I think this goes back to the conversation you and I had yesterday morning, which is, as you said, look, there is this narrative. The doves are being handed a much stronger mandate to be much more vocal. And we saw that just last week with a couple of them. But the question is, what's the haunting shadow that hangs over them? Is it the 1970s or is it the 1980s when we had that Reagan administration and then they had to pivot, the Fed had to pivot? So that's, I think, on the back of their minds.
The problem is the fog of 2025. And part of that, Manus, is politics. Right. Jane Foley of Rabobank writes this: if Trump were to move to enact large tariffs early in a second presidency, the Fed's rate-cutting cycle would be cut short. Ironically, this implies that a second Trump presidency is more likely to be associated with U.S. dollar strength versus weakness. And Jane joins us now, who is head of FX strategy at Rabobank. Jane, great to see you this morning. We've had a very healthy debate about this week of what Trump policy, would he be elected, actually means. Manus and I were catching up with Stephanie of Wolf Research, Roth of Wolf Research, who said that it translates into economic weakness, that higher tariffs, if it's inflationary, it's bad for the consumer because they'll have to pay more for goods. Therefore, weakness slows, and therefore it is actually not a case for the Fed to be hiking rates for any sort. I just want to get your case. Why does it mean a shortened cutting cycle if we do have a Trump presidency with huge tariffs on the way?
Well, I think the Fed is part of that equation, really. We'll get a slower economy, and partly because the Fed will have to react because of the inflationary risks. So, you enact large tariffs so that the goods that you are importing, say, from China, are now more expensively priced. And so you have an inflationary shock to which the Fed will therefore react to. And therefore, yes, you do get slower growth, which isn't great, but the immediate reaction will be, higher inflation, and the Fed's cutting cycle will probably have to be cut short. And so initially, if we assume that there is still an interest rate cutting cycle going on in other parts of the G10, initially the dollar could benefit from the interest rate differentials. But yes, further out, it means a weakened growth outlook for the US economy, and therefore that adds different parameters and maybe a softer dollar over the longer term.
Let's throw the left tail risk at you, Adam Posen. Good morning. Good to see you in the flesh. It's been a while since I've been in London. Adam Posen has been on the show with Danny and has been on the show with the surveillance team, and he talks about the probability of a near-term cut from the Fed, but then you have an inflationary, tariffs and immigration, etc., and that the Fed would have to pivot, and pivot pretty darned hard in the back half of 2025. Do you see a case for that if there is a Republican sweep, that we may have this pivot? And that it's almost like a double support for your narrative on the dollar, isn't it?
Yeah, I think that's quite likely. I mean, there's a list of potential impacts from Trump policies that could have an inflationary bias. And you mentioned immigration being one of them. Shortages of workers, for instance, adding up to more pressure on wages. All of this is potentially inflationary. It's ironic in a way, because if we look back into the first Trump presidency and we look at the rhetoric of Donald Trump, he went against what's been a Treasury policy for a long time, and that's a strong dollar. He would want a weak dollar because he wants to reset the trade balance, and that is what perhaps fueled that Wall Street Journal article some months ago, that a Trump presidency, if it came again, Trump would want to have a little bit more control on the Fed.
Yeah.
Now, I'm disregarding that, because, the chaos that would assume in terms of, Fed credibility policy, I think would be so disastrous. I don't think Trump's advisors would allow him to do that. But, that is another tail risk, which I think would really create a lot of downside pressure from the for the US dollar.
Yeah, and even Team Trump came out after those reports and said, don't believe it unless you hear it from the mouth of Donald Trump himself. And you continue to get this pushback, which again, Jane, leads to the point of confusion and fog for 2025. As we head into that, we had New Zealand Central Bank, for example, today saying that they're holding and we're getting closer to cutting rates. You hear from Powell, as Manus and I were discussing, holding, getting closer to cutting rates. How much can you trade that at this moment, at a time when you continue to get these head fakes, when the data is bumpy, and you have a Fed that seems hesitant to move too quickly for mistakes that they've made in the past?
I think there's a common denominator, really, through many of these G10 economies, and that really is the labour market. That is coming through into services sector inflation. That's a parameter that's really a worry, a constraint, perhaps, and has been for some months for several central banks. I mean, we can talk of that in the context of the Fed. We can certainly talk about that in the context of what's perhaps been keeping the Bank of England back, and also, for the ECB going forward. Maybe if it wasn't for high service sector inflation, the ECB could be cutting again a little bit sooner. So that is a concern, the services sector, and that comes back to labour market shortages, really, across most of these markets. So again, common denominators, are a theme here.
I just pulled up euro dollar for 10 days. Drive on. Nothing happened. Absolutely nothing happened. But I want to get your perspective on the euro. I was looking at euro-Swiss volatility, and I was really surprised. Obviously, there was a haven trade. Swiss went bid. Euro tanked. Some would say the worst scenarios are contained on the left and on the right, and you have this appalling cohabitation, which is a state of, in Ireland, we say a state of chassis rather than crisis. So it's this sort of stalemate. When you look at the euro and the collapse in volatility in Swiss, is that the right reaction function? Because I don't think the worst is past.
No, and I think that's really the clue here. I think that's the crucial thing. The worst may not have passed. There may be another French election, say, in a year's time. The Parliament can't be dissolved twice within a year. That may bring in the far right. Meanwhile, in the coming 12 months, can the French government, if one is able to be put together, put in a budget which is going to satisfy Brussels? France had the second worst budget deficit, 5.5% of GDP in the EU. I think Romania was the worst over the last year. So there's a lot of work to be done and perhaps not ability to do that. So the worst may not be passed. And that's quite interesting for the Swiss franc, because the Swiss franc tends to do well when we're all worried about the euro, the eurozone. Now, to give that a bit of context, the S&B doesn't want a strong Swiss franc. It's quite happy when it's losing ground because of its long history with deflation and disinflationary pressures. So the S&B have been on the front foot. They cut interest rates early when people didn't think they would. They cut again when many in the market didn't think they would. They could go again quickly because inflation is below 2%, and that's perhaps what's keeping the Swiss franc back. But I think if we are in 3 months, 6 months or 12 months' time very much worried about the budgetary situation in France and maybe Italy as well, I think the euro could certainly have more downside pressure and the Swiss franc could move higher.
OK, despite those cuts, a lot of work to do at the S&B. Jane, good to see you. Thank you so much for joining Danny and I this morning. That is Jane Foley of Rabobank. Let's just circle back and focus in on geopolitics. It really is top of the agenda. NATO has opened its summit in Washington by promising 5 long-range defense systems for Ukraine. Here's what Biden had to say yesterday.
The United States will make sure that when we export critical air defense interceptors, Ukraine goes to the front of the line. That will get this assistance before anyone else gets it. All told, Ukraine will receive hundreds of additional interceptors over the next year, helping protect Ukrainian cities against Russian missiles.
Joining us now from Brussels is our bureau chief, Kevin Whitelaw. Kevin, a very robust Biden there. Obviously, this is about the theatre of how he presents and also commander-in-chief, USA defender of Ukraine. It was a strong message, and really this is as much a politicking as it is a global positioning of Biden in the past 24 hours, isn't it?
Well, that's right. I mean, of the 5 systems that were announced, several had actually already been previously announced. So an element of what happened is a repackaging of promises that have been made in the run-up to the summit. So, for Ukraine, they're really eager to get the actual material, get actual aid, and a real signal from NATO that there's a membership path. They're not going to quite get that latter one. They still want more air defenses than they're getting, and they're all looking down the barrel of the possibility that with the Donald Trump presidency, looking maybe a little more likely than it did a few weeks ago, that the flow of U.S. aid, the U.S. military support, may be vastly constrained, if not entirely cut off.
And it's not just the U.S., Kevin. It is multiple leaders in the NATO summit that are weakened, from Scholz to Macron. And, of course, the irony is probably the U.K., which usually sees its fair share of political volatility, perhaps has the strongest leader in Keir Starmer. What does that mean for the fragility of NATO in trying to pass these sorts of resolutions and trying to aid their hand to helping Ukraine and other political landscapes that are constantly shifting?
Well, it's going to be an obvious problem. Emmanuel Macron, very distracted as he tries to form a government, and obviously the strength of the far right there, leading to some questions down the line about France's commitment. German Chancellor Olaf Scholz also dealing with his own political challenges back home. So far, the European Union has managed to push through very strongly when it comes to aid for Ukraine, even when it means navigating around 1 or 2 holdouts like Hungarian Prime Minister Viktor Orban. That's going to get harder if it's a big country, because moving around Hungary is one thing, moving around, say, France is another. It does lead to the potential that the UK could become a closer partner, particularly if the U.S. Contribution starts to go down if Trump wins. So there's some interesting possibilities there for them. But it's going to be a problem, and that's a problem Russia doesn't have with its unified political system under Putin and its ability to withstand all kinds of pain.
And Putin himself has had a lot of visits from world leaders as of late. Kevin, we appreciate it. As always, Bloomberg's Brussels bureau chief, Kevin Whitelaw. More to come next on Tech from your morning view of London.
It's Bloomberg Brief. I'm Manus Cranny in London. Danny Berger in New York. We're still together. It's good to see you. So, tech titans, Danny, we're going to talk about this. They, passing on a board seat on OpenAI. Why? Microsoft announced its withdrawal from the board. Apple declined to take an open seat. And the move comes as global regulators look into big tech's clout in AI. Tom McKenzie is around the desk with us this morning. Tom, good to see you.
Yeah.
They put in how much? Microsoft put in what? 13 billion?
13 billion. 13 billion.
They must have a lot of faith in Sam that they don't need to be on the board.
Yeah, maybe their statement is a little disingenuous. Look, you'd expect that they might want some oversight. And they are going to get that. OpenAI says, look, when they come up with a different structure, we'll keep our main investors, including Microsoft and Apple, informed and updated. Because we know that Sam Altman is a controversial figure. You go back to November, he was briefly ousted, of course, from OpenAI as CEO. But it was Microsoft, it was Satya Nadella, given that $13 billion investment, that led him back to that key role as CEO of OpenAI. They rejigged the board completely. Only one member survived in terms of the previous board, reworked it. They had this observer role. Now they say after 8 months, we have witnessed significant progress from the newly formed board and are confident in the company's direction. That does not tell the whole story, of course. Apple as well, really interesting, given their partnership with OpenAI. They embed it into their services. Part of Apple Intelligence, they are also not taking the board seat. And part of this is certainly down to that regulatory scrutiny.
Tom, taking a step back from OpenAI to all of AI, because we're about to enter earnings season when so much is riding on the big AI names. We got maybe a little taste in TSMC sales this morning. What did it tell us?
Yes, very interesting. So obviously a main foundry, the manufacturer, the key manufacturer, of course, for NVIDIA's GPUs, for Apple's chips, as well as a host of others. You cannot progress and make these chips without TSMC, based in Taiwan. So they came out with expected sales numbers higher than expected. And it just reminds us that the demand is still there for this AI hardware, for the chips that are embedded into the data centers on which you can build and train these models, these foundation models, on which you can then layer these AI services that are customer-facing. So TSMC is really important, not just an individual corporate story. The stock is up, as you can see, close to 90% year-to-date, but as that litmus test, as that indicator in terms of the demand for generative AI. And on their sales numbers, at least from today, that came through earlier this morning, then it suggests that demand is still pretty red hot.
Hey, Tom, appreciate it. Bloomberg's Tom McKenzie there on the tech story. Let's now get to the airlines. A sigh of relief for Boeing, airplane makers, rather. The troubled plane maker announced that it delivered 44 commercial aircrafts last month. It's the highest total of the year so far. Let's bring in Bloomberg's global aviation editorial leader, Benedict Campbell. Benny, some rare good news for Boeing.
Yeah, you're absolutely right. Good news and Boeing aren't words you typically hear in one sentence, at least for the last 6 months. That's not been the case, but we got a fairly good set of numbers from them yesterday, late yesterday, on the monthly orders and deliveries. So they, as you said, managed to ship 44 aircraft, most of them the 737 MAX, so the short-haul plane that's been sort of at the center of attention because of that January mishap. The question really is, will they be able to maintain this kind of cadence? Will they be able to increase it even? And the same goes for Airbus. If you look at the two companies side by side, Airbus had its numbers a day earlier. They delivered 67 planes, so there is a bit of a delta there in terms of the delivery numbers. But both companies still have quite a bit of room to improve here. Boeing is somewhat restrained because the regulator has told them you can only produce a limited number of planes because we want to make sure that you're getting your process in order, your factories in order. So they are more limited there, but as you said, some good news there. At least the numbers didn't go down.
Do you know what I'm having a look at? Danny, be proud of me now. I found a function. Always dangerous when I re-find a function from 15 years ago. SPLC, that's supply chain, the feeders in and the feeders out. How much crossover? I mean, I know that they're doing the Spirit Aerosystems deal. That brings supply chain in-house and control. How much crossover is Boeing going to suffer with Airbus in terms of that supply chain? Because Airbus are saying, look, it's the supply chain. We just can't get the bits. And here's Boeing. So what's the cross-contamination if we can contextualize it like that?
Yeah, I mean, there is considerable cross-contamination, if that's, the right term, because, if you look at the Spirit takeover, yes, most of it will go back to Boeing, but there is also a not too small chunk that will go back to Airbus, and that gives you a sense of just how interlocked this industry is. They buy the same engines, they buy the same interiors, they buy, the seats come from a limited number of suppliers, and it's that sort of limited nature of the industry. It's a very highly specialized industry and somewhat limited that creates these complexities that they've all been struggling with. As you said, Airbus came out with this profit warning last week, not because of demand. The demand is there. The airlines are buying the aircraft. It's the supply side. They cannot make the planes fast enough that everyone is buying. We'll get a sense of that next week at the Farnborough Air Show. That kicks off at the end of the month, and there'll be a lot more there to find out sort of what the mood in the industry is like. How drawn out will this crunch be? Are we talking 6 months? Are we talking 2 or 3 years? It could really be a considerable amount of time.
Well, I can certainly tell you both, I felt the pinch in terms of the price of the airfares to here and onwards to Ireland. Bring down those fares. Michael O'Leary would be happy, but not exactly flying with Ryanair. Benny, thank you very much. Benny Camel there on the latest from Boeing. Coming up, it's a full day of Fed Speak. Danny and I will break it down for you in just a moment on Bloomberg. Good morning from New York and London.
It's your Bloomberg Brief. Let's get you set up for your trading day on this Wednesday. It is day 2 for Fed Chair Jay Powell as he testifies before the House Financial Services Committee. That's at 10 a.m. Eastern. Then we'll hear from Chicago Fed President Austin Goolsbee and Fed Governor Michelle Bowman. They'll deliver remarks at 2:30 p.m. Eastern. And then more Fed speak on the docket. Fed Governor Lisa Cook speaks on global inflation and monetary policy changes in Australia. Manis, what do you got for stocks?
Danny, got you a little bit of tech, never far from our minds. NVIDIA rising after the supplier TSMC. Their sales surge past expectations, the fastest pace since 2022. That's how we started the show. That's how we ended. Apple is bid an eighth of 1%, and Microsoft also relinquishing their opportunity to sit on the boards of OpenAI. But that's more about sort of batting back against the regulators, Danny, isn't it? There's no doubt about it. The bond market is in focus. I think I got it the wrong way around. I said that the 10-year auction went grand at the start of the show. Of course, it was a 3-year auction that went grand yesterday. It's $39 billion of 10s coming down the pike today. More good data, apparently, Danny. That's what Powell is waiting for.
The bond market listened to Powell and was maybe ever so slightly disappointed because yields moved higher as Powell was speaking because we've already baked in so much dovishness from the Fed chair. But it was that bond auction going well, Manis, that allowed us to dive back into this market. There are just so many currents push and pulling between auctions, Powell, and politics. It is the fog, I'll say it again, of 2025.
I got to say, that line, that is the truth. No, there's the fog of politics, the fog of inflation, and the fog of unemployment. But is there enough term premium to buy bonds? We'll do it all again tomorrow from London and New York.